Hello, everyone. Welcome back to Investing in Personal Finance channel. Happy Saturday. It's Saturday, September 14th, 2024. And purpose of this discussion is to talk about the S&P 500 valuation and how it's a cautionary tale based on very low dividend yields and earnings yield. And this is based on the market close of Friday the 13th, no less, right? So first, let me show my disclaimer, which I will leave at the end of this video in greater length. And let's go back to the presentation. And one of the things I've noticed is that a very low dividend yield on the S&P 500 typically predicts either a market correction or a bear market. And I'll show you what I'm talking about. Click on the link under bullet 2. And this takes us to a chart of the historical dividend yield of the S&P 500. Now, the all-time low, if you look down a little bit here, was 1.11, which was in August of 2000. That was really just a few months before the dot-com bubble bursting in the year 2000, right? It was at 1.11. Well, where is it right now as of Friday the 13th, no less? It's at 1.28. So it is almost at an all-time historic low. Now let's just look at the history. So let's go back to, if you look at, here's the low, which was in August of 2000. That preceded a market bubble. Let's look at prior dips. If you look in, if you look in July of 1987, if you look on the chart here, it took like a near-term bottom, right? And that was in July of 87, but we know what happened in October of 87, right? That was a market crash. Let's look at other historic lows of the dividend yield of the S&P 500. You see in, I would say, January of 1973, it hit like a near-term low, a pretty significant low, no less. And we know that the 73, 74 stock market was awful, okay? So there's definitely, here's big proof for you. Right before the Great Depression, look at the big low. In July of 1929, that was an historic low. And we all know what happened in October of 20. So I think the evidence is pretty clear here. So that's one thing. Okay. Now let's talk about the earnings yield, which is not to be confused with the dividend yield. Let's look at that. So I'm going to use SPY, which is the exchange traded fund, which tracks the S&P 500. I'm going to click on that under bullet 3A. And to calculate the earnings yield, you basically flip the PE. So the PE is 28.31 on the S&P. So you actually do 1 and you divide it by that number. So I'm going to bring up my calculator. And we're going to do 1 divided by the 8.1 equals, and you move the decimal over 2 places to get the earnings yield of the S&P 500, which is only 3.5%. That is very low. Okay. So now what you want to see is you want to see how the earnings yield of the S&P 500, which is risky, it's the stock market. How does that compare to the risk-free investment of a 10-year U.S. government bond? Let's look at that. So if I click on that, it's under 3B. That takes us to the U.S. Department of the Treasury website, and it just so happens to have the yield on the 10-year note, which is 3.66. So the yield on a risk-free investment, U.S. 10-year government bond, is 3.66, where the yield on the S&P is only 3.5. So I think the evidence is pretty compelling. So just to recap, low dividend yield on the S&P 500 typically precedes a market correction or a bear market. And also, when comparing risky assets such as stocks, they should have higher earnings yield than the yield on a 10-year government bond. In this case, it's low. So anyway, thank you for watching. And please like my video and subscribe to my channel. And here is the disclaimer I promised you to read.